Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Thursday. It is the 29th of April. It's a very, very important day because we have the GDP report that's going to be released in about half an hour. Now, the expectation quarter-over-quarter growth is expected to be 6.5%. But as you could see here, there's always a but, right? As you could see here, the range is really, really tight. Wide, not tight. The range is really, really wide, which means there's really a very little in terms of very specific indications of how it's going to shake out, which means the market can really move if it doesn't go the right way. As you could see here, last quarter, we had a 4.3% increase. We're looking at 6.5. If we can gain 7%, 7.5%, that would be really, really bullish for the market. Anything above 6.5%, quarter over quarter annual rate would be really, really good. As far as personal consumption expenditures, prior was 2.3%. We're looking at 10.5%, which is quite a bit. So I'm not sure if that may be a little too ambitious, but again, these are the numbers you want to look at. And if the numbers are better than this, even if they're a little bit better than this, that's a good indication for the economy. The second report that's coming out, and this is also one of the bigger reports for the week, is the jobless number. Now, you guys know I've been all over this like white on rice. We went from about 700,000, 750,000 new claims a week, and this is timely. This is as of last Friday. This is 6 days old right now. So this is telling us employment numbers are in fact getting better, that more people are getting jobs and less people are filing unemployment claims. We're now in the mid 500s. We went from 750, we were there for a while, 800,000, we were there for a while. And then we kind of dropped all the way from 700 to 5 something. If we can get, and again, we've had 3 weeks of claims below 600. So if the number is anywhere in the 500s, I'll be very, very happy. Honestly, I'm expecting a bump back up, which wouldn't be great. But if the number's in 550,000, 580,000, 575, 520, I'll take it. I'll take it. Honestly, anything below the 4-week moving average would be welcome, which is 651, because the last few numbers were just so darn good. We had 547, then we had another 500, and then we literally had very little in the 600s. We went all the way from 700 all the way into 500. So I'm thinking it'll kind of bounce back and kind of fill that gap, for lack of a better term. So keep your eye on these two reports. They're going to be coming out in 28 minutes. I wanted to do this report nice and early before the reports to give you a good indication of what's happening. Now, the bond market. Remember, we had yesterday, as you could see in this calendar, we had FOMC data, and I'll get into the reports. Basically, they're not going to do anything right now, but if the economy heats up, they may take action. Bottom line is, I think the bond market is going to stay range-bound. I think interest rates are going to stay between 1.5 and 1.7. Long-term bond, the 10-year, 20-year long-term bond, anything over 10-year. They are very highly correlated. If you look at 10-year, 20-year, 30-year, their correlation is almost 100%. It's like 97%. So I think the long bond, that's why I always say the long bond. And if I was to look at the 30-year or the 10-year futures, it would look exactly like this. I mean, exactly like this. So we're bouncing off the 50-day line. We made a 90-day swing low, and I think we're going to kind of come down, but I don't think we're going to break this low level for a while. I think we're going to kind of hover around this level for the foreseeable future, meaning maybe another 2 months. And then as we get into third quarter and fourth quarter, I think interest rates are going to go bonds are going to go lower, which means interest rates are going to go higher. Remember, there's an inverse relationship. Interest rates were less than 1% right here. They were 1.78 right here. So the more bonds decline, the higher interest rates go. So remember, there's a complete inverse relationship. And I think we're going to go lower and we're going to break this low, but it's going to take some time. Now, markets are higher pre-open. They're actually looking really good. And if we were to look at the SPY, you will see that we are literally, I think we're at new highs right now, right? Let's take a look. Yeah, we're at new highs right now. But we've had a nice little flat area, so it may extend. Folks, I'm going to show you this just because. I know I go through this every day, but you've got to see this. Be careful. Be very cautious right now. This is not a time to be a hero. Momentum levels, Number of stocks above 200-day, 94 percentile. Above the 50-day line, 87 percentile in the S&P. We are so overbought. We are so stretched out that it's sick. So there's a good chance the stock market will come down a little bit, which will cause bonds to kind of stay within the current range. But keep your eye out on the momentum levels because, yes, the market is overbought. Yes, the market is making new highs. But that rubber band, folks, it's stretched out like there's no tomorrow. Now, let's talk about global economy, and then I'll give you a hot pullback stock that's not overbought right now. So world shares advanced Thursday ahead of the release of U.S. economic growth data. That's what I've been talking about. That's coming out right here. Again, my job here is to connect the dots for you before the opening bell. And this will give you good data for the next 24 hours. And followed by a speech by President Biden outlining ambitious plans for beefing up early education and other family-oriented policies. Americans love that. U.S. growth in the January-March quarter could top 5%. We were talking about the targets. We were looking at the numbers right here. When we were talking about topping 5%, we're looking at 6.5% to be specific. Again, I'm trying to connect the dots for you. Even more than 10% or even more in the current April-June quarter as pent-up demand fuels spending. Remember I told you that spending is going to go crazy, consumer spending is going to go nuts this quarter? It is, and you will see that reflecting in the GDP. In his speech Wednesday evening last night, the president ticked off detail of some of his plans for $1.8 trillion in spending to expand preschool, national family and medical leave programs, distribute child care subsidies, and more. I love all that, but remember something, folks. It all sounds really great, but somebody's going to have to pay for it. Oh, man, don't get me started. The plan comes on top of his proposed $2.3 trillion in spending to rebuild roads and bridges, expand broadband access, and launch other infrastructure projects, which we really need. This is the time to do it. But folks, we're looking at $2.3 trillion. We're looking at $1.8 trillion. We're looking at $5 trillion. My question to you is, where is Biden going to get this money? Let me answer it for you. From our future. That's the problem. So we're going to pay a lot of our future for these luxuries right now. And I'm hoping it's going to be worth it because it's taking a lot of our money. Our deficit is just getting bigger by the moment. Smaller stocks, Russell 2000, as I mentioned, continue to fare better than the S&P and the NASDAQ, even though they took a little dump over the last month or two. But they're coming back, and they're coming back hard. And yes, even though the Fed says there's not going to be any inflation or a lot of inflation, yeah. Have you been to the lumber store? Have you been to the supermarket lately? Have you looked at egg prices, lumber prices, copper prices? No inflation. The expectations for a strong rebound and rising price for oil, lumber, and other commodities have also spurred concerns over inflation and prospects of higher interest rates. Yes, bonds going down, higher rates. These worries push bond yield higher. Exactly. In its remarks, the Fed noted that the economy and job market have strengthened, which is true. It acknowledged that inflation has risen, but it says it sees the increase as transitory. I don't know about that. Lumber prices are definitely not transitory right now. Fed officials have said that they want to see inflation exceed their 2% annual inflation target before they consider raising rates. Yeah, maybe they won't raise rates, but maybe they'll lower the amount of liquidity coming into the bond market. Maybe they'll stop being so aggressive in their purchases, which I think would happen before they would consider raising rates. I think that would be an interim action, which is what Jeff Zananeri and I talked about yesterday. And benchmark crude oil rose 50 cents. It's at $64. I think energy prices are actually going to go down a bit. They haven't been able to trade above last February's level. The demand level is too high. And I think energy prices are going to pull back, but non-traditional energy, non-traditional renewable energy, EV energy is going to rise. So that's going to kind of offset that market a bit. Now, I don't have a lot of hot stocks for you today, but I do have one that's pulling back and it's looking great. And I've been all over this one. Corning, they make plastics. They make not plastics. What am I saying? Information technology, innovations in materials science, glass science, ceramic science, and plastics as well. They make a lot of things. But drawing, insulating of non-ferrous wire communication components, infotech, folks, that sector is getting really, it's gonna, it enhances people's lives, and anything that enhances people's lives is hot right now. Manufacturing, engineering, they're doing a lot of stuff with plastics and glass, ceramics, optical physics. It's this company, what they're inventing is going to be used for in our technology over the next decades. 1 year return, 100%. I like how the stock is pulling back right now. It's got really good earnings estimates and surprises, as you could see here, 4 quarters of each. It's got a price target of $55 a share. That may be a bit too ambitious. I'd go for $50 a share over the next 8 weeks, and I think we're going to get there. Let me go back to the chart. I would be buying this at the 44.60 level and liquidating it at the 43.50 level. I like this pullback. I think the stock is going to reach out and trade and test the highs and go higher over the next 8 to 10 weeks, especially with this rally we're having in the market. So I do like the stock. It's a large cap pullback, GLW. Corning, not a small company, a big company, going for a good pullback while the market is rallying strong. Now, you've got to be very, very careful right now. We've got a lot of economic data. The markets are grossly overbought, but with this liquidity coming into the market, we may be in for another big run, and I don't want you to miss it. So check out these pullbacks. You want to stay away from overbought stocks, but stocks that are pulling back are a little less risky right now, and that's what we're focused on. Now, I'm willing to bet, most traders don't know this, but massive hedge funds, and I mean massive hedge funds, institutions and banks, they're gearing up to take over the stock market's algorithmic trading. Folks, it's happening. Terminator, remember Terminator? It's happening. We're here. And they plan on leaving everyone in the dust. I don't want you to be left in the dust, but there's still hope left for the everyday investor and trader like you. You see, I've developed an algorithmic trading machine that investors can use without millions of dollars in upfront capital. This is the best algorithmic trading that takes your emotions away from the market. Very, very high, very high probability of profits. Don't need a big account. And the machine, man, I've set this machine up to think like a professional trader. You've got to check out Storm. It is the coolest thing ever. Get in on this now. Check it out. You don't need a lot of money to get started. Click on the link below, and I'll show everyone how not only to get ahead of Wall Street, but supersize their trading account in their process. Folks, we've been seeing gains of 70%, 40%, over 100% in weeks, and it only holds position for 5 days. You've got to check this out. You don't want to miss out. Get access now. Follow the link below and learn everything you need to learn how to supersize your account now. Have a great day. Bye, guys.